Welcome back to Primary Source China Investment. This week we're on show Q5, and we thought maybe China's grown up and is too big for EM. So in the past few weeks, there's been a lot of press about the Global South, EM, and a renewed interest in the Belt and Road as they celebrated their third forum, although it's been more than a decade. This is against the backdrop of other geopolitical discussions about the expansion of NATO, the UN's response to Hamas attack on Israel, Ukraine and Russia, and on and on. It's a lot for a simple investor to digest, but Peng Guo and I are up for the challenge. So recently, Rayliant, a firm that I have a lot of respect for, reissued their emerging market ETF, RAYE, to carve out China. Of course, they have a bespoke China ETF, RAYC. For those of us old enough to remember country groupings of the past, such as Asia Pac or Asia ex-Japan, this is a recognized strategy. The reason this strategy is being implemented now is because China's actually gotten too big for EM. It's really dwarfing EM. And Rayliant points this out. They say, look, China is 30% of MSCI EM. The other problem is, and we've talked about this a lot, Peng Guo, the other problem we have here is a lot of these Chinese stocks are not mainland listed stocks. So you're getting a lot of Hong Kong listed and even maybe some American, US listed. Furthermore, the return correlations make no sense. A shares are simultaneously not correlated with EM and also not correlated with offshore China. This data here is from almost 2 decades. So you're really blending a lot of things that may or may not go together, and your returns are really not correlated, which in general means you have a lower volatility. But because you're looking at China as one big basket, you're not getting the return, the pure return of China. And we'll get into what that really means. So, Peng Guo, is China too big for EM? Should it be its own asset class?
I think the criteria is subjective. So people can do whatever and organize for those countries as they want. But the bottom line is China is too big to be ignored. Yeah. And also, I think it's too complicated to be simply put into the one basket. Yeah, I know the Asians and overseas China companies, they really show the different characteristics. So how to organize and create an appropriate index to track them, I think is very important. And also because the new technology emerged in the security market, many companies, they cross the board. So you never know is that should be put into a traditional way, into the like the geeks or traditional classification, or it should be adjusted, or should combine them together. I think the industry classifications should be the first questions to get started, so you understand at least in each subsector area how many companies really play in those area. Yeah, that's changing too fast.
Yeah, the first thing you said is important. You really bring up a beta problem. Where the stock is traded matters because you're subject to that market volatility. So if you're a Chinese company listed in Hong Kong, on the mainland, or in the US, you're going to have a different beta profile. And I think that goes to the reason of the volatility. The second thing is definitely industry classification. You and I talked about it a couple of weeks ago. We said, tech or telecom, and those are really, really blended. And if you're looking at tech and not looking at telecom, you're really missing a big opportunity. The other point I wanted to talk about is, index providers and product issuers, they tend to try to make things easy. Like, remember when BRICS first came out? Yeah, it's a catchy name, but these countries, or whatever the global South may look like, is a horrible investment thesis. These countries don't move together in any way. These countries have very different profiles. They have different geopolitical structures. I mean, and some of them are just declining. Like Brazil and Russia, GDP peaked a decade ago. So this notion that, oh, BRICS is a great way to invest, it actually makes no sense. If you're a real asset allocation professional, the last thing you would do is lump everything together and hope.
Yeah, you're right. You cannot just right now is more like the be highly selective for those assets. If you just invest in the whole basket, they pretty much each one have the not a, different performance. So the overall is obviously is very disappointed. I know that.
Yeah, your point is even accurate on a long-term basis, because if you look at asset allocation over that long-term basis, and if we're keeping things, if we're, as the kids say, if we're keeping it real and we're keeping score, and investing is all about keeping score, the S&P 500 has wiped the floor with EM, and it wasn't even close. Since 2005, EM returned 56%, and the S&P returned 256. So it's not even close. And on a long-term basis, EM has really, well, it's given you a lot of volatility. It hasn't given you a lot of return. But given that, you might say, well, you know what, Gerard, forget about China. You'd be wrong, because since 2009, the CSI 300 has returned more than 164%. So it's really outpaced EM. It hasn't matched the US S&P 500, but it has given you return, even though there's been a big sell-off for the last 2.5 years.
Yeah, I think this is also have another very different research perspective. I just read the British research paper is about the profit. So even there's so many companies in the world, but with the profit, how they get split. And their conclusion is a U.S. company take the almost 60% of more than 60% of the profit in the market.
Yeah.
That means the 2/3 of the profit flow into the United States. That's why I explain the SP 500 can get up much higher performance than any other country's index. Yeah,
right.
It's still a pretty good one.
Right. Well, we're going to leave it there with show Q5. Thanks for tuning in this week, and we'll see you soon.
Thank you.